In a nation grappling with economic shifts, one nomination could reshape the financial landscape. Markets surge as President Trump taps a bold voice for the Federal Reserve's helm. But controversy swirls. Will investigations and Senate hurdles derail the path forward? Tonight, we delve into the stakes for America's economy. Welcome to Worldview, where we bring you in-depth analysis of global events shaping our future. I'm your host, delivering the facts with clarity and context on the issues that matter most. From nominations that could influence interest rates to the housing market's revival, we examine the forces at play in this pivotal moment. Before we start, wherever you're watching or listening from, drop a comment, hit like, and subscribe to the channel. Today, we'll continue this conversation in the comments and respond to your questions. As we turn our attention to the evolving dynamics within the U.S. financial system, it's essential to consider the recent developments surrounding the leadership at the Federal Reserve. President Trump's selection of Kevin Warsh as the next chairman has sparked immediate reactions across financial markets, underscoring the profound influence such appointments hold over monetary policy and economic stability. This move comes at a time when the economy is navigating post-pandemic recovery, technological advancements, and persistent debates over inflation control. To fully appreciate the implications, let's step back and examine the broader context. The Federal Reserve, often referred to simply as the Fed, serves as the central banking system of the United States, established in 1913 to provide a safer, more flexible, and stable monetary and financial framework. Its dual mandate, to promote maximum employment and stable prices, guides decisions that ripple through every sector of the economy, from Wall Street trading floors to everyday households budgeting for mortgages and loans. Over the years, Fed chairs have become household names, their policies debated in Congress, analyzed by economists, and felt by consumers. Figures like Alan Greenspan, who steered the economy through the dot-com bubble and 9/11 aftermath, or Ben Bernanke, who navigated the 2008 financial crisis with unprecedented interventions, illustrate how leadership at the Fed can define eras. In this instance, Kevin Warsh emerges as a nominee with a background deeply rooted in economic policy and financial markets. A former Fed governor from 2006 to 2011, Warsh was appointed by President George W. Bush and played a key role during the height of the financial crisis, contributing to strategies that included bank bailouts and quantitative easing programs. His tenure provided him with firsthand experience in crisis management, but he has since become a vocal critic of certain Fed approaches, particularly in recent years. Warsh's perspectives, shared in various public forums, highlight his belief in recalibrating monetary tools to better align with current economic realities. Reflecting on a prior discussion from July, where Warsh appeared on a prominent financial program, his views on interest rate policies and the broader U.S. economy offer insight into what his leadership might entail. He expressed frustration with the current Fed chair, Jay Powell, arguing that the central bank's policies have contributed to uneven economic conditions. Specifically, Warsh pointed out that while financial markets on Wall Street benefit from loose monetary conditions, everyday businesses and consumers on Main Street face tighter constraints. This disparity, he suggested, stems from a mismatched policy framework, an oversized balance sheet reminiscent of emergency measures during the 2008 crisis or the 2020 pandemic, coupled with interest rates that remain elevated. To unpack this, let's consider the Fed's balance sheet. This refers to the assets and liabilities held by the central bank, which ballooned to over $8 trillion during the pandemic as the Fed purchased government securities and other assets to inject liquidity into the economy. Quantitative tightening, the process of reducing this balance sheet, has been underway, but Warsh advocates for a more aggressive approach to normalize it. Simultaneously, he calls for interest rate reductions to ease borrowing costs. This dual strategy, in his view, would foster a more balanced economic environment. Warsh's critique extends to the Fed's overall direction in monetary policy, including expenditures on infrastructure like building renovations, which he sees as symptomatic of misplaced priorities. Such spending, he argues, erodes the institution's credibility, a cornerstone of effective central banking. Credibility ensures that markets trust and respond to the Fed's signals. Without it, policy actions can backfire. For example, the Fed's 50 basis point rate cut just before a major election led to a paradoxical rise in long-term interest rates by nearly a full percentage point, signaling market skepticism. Looking ahead, Warsh envisions a regime change at the Fed, not limited to the chairmanship but encompassing a broader refresh of personnel and strategies. This comes amid what he describes as a transformative period in American economic history, driven by technological innovations that could boost productivity over the next 5 to 10 years. Positioning the U.S. at the forefront of this wave, he believes, requires adaptive monetary policies that support growth without fueling inflation. President Trump has publicly stated that Warsh's confirmation should proceed smoothly, yet challenges loom. Outgoing Senator Tom Tillis from North Carolina has pledged opposition unless an ongoing probe into Powell and a Fed renovation project is halted. This investigation, spearheaded by figures like Jeanine Pirro, focuses on expenditures that have escalated to nearly $4 billion for what was initially described as a modest renovation. Trump, drawing from his own experience in real estate development, such as his $200 million overhaul of the Waldorf Astoria, has criticized the project as indicative of incompetence, potential theft, or kickbacks. He humorously noted that the incoming chair might lack an office for years, highlighting the project's indefinite timeline. To provide deeper context, the Fed's headquarters renovation in Washington, D.C., began as a necessary update to an aging building constructed in the 1930s. However, costs have spiraled due to factors like enhanced security measures, seismic reinforcements, and modern technological integrations. Critics, including Trump, question the value and oversight, especially when juxtaposed against the Fed's role in managing national finances. This scrutiny underscores broader themes of accountability in government institutions, a recurring motif in political discourse. Joining the conversation is William Poult, director of the U.S. Federal Housing Finance Agency and chairman of Fannie Mae and Freddie Mac. These government-sponsored enterprises, GSEs, play a critical role in the housing market by providing liquidity through mortgage-backed securities, enabling banks to extend more home loans. Poult's perspective is particularly valuable given his oversight of portfolios exceeding $7 trillion combined. Assessing Warsh's confirmation prospects, Poult expresses optimism, viewing it as a strategic choice by President Trump. He emphasizes the need for a Fed chair who avoids politicizing the institution, contrasting this with Powell's tenure, which he sees as having turned monetary policy into a partisan issue. Poult highlights the renovation controversy as a straightforward matter of fiscal responsibility. Why allocate $4 billion to a building project amid economic pressures? He anticipates Powell's departure in May as a positive shift, one that the housing sector eagerly awaits. Addressing critics who question the necessity of investigating Powell, especially with his term nearing its end, Poult clarifies his non-involvement, noting he has no direct ties to the Department of Justice or Pirro. As someone with extensive construction experience, his family founded Poult Group, one of America's largest home builders. He points to anomalies in the Fed project. During a tour last July, he observed redundancies like installing a new basement in an area with low water tables, requiring complex engineering like a reverse bathtub structure to prevent flooding. Such elements raise questions about cost justifications and potential beneficiaries. The investigation's core, Poult explains, revolves around Powell's testimony to Congress, whether statements under oath regarding the project were accurate and transparent. This isn't merely about spending, but about integrity. Discrepancies in small matters can signal issues in larger ones. With $4 billion at stake, Poult argues for thorough examination, citing details like protective wood coverings on doors during interior work, which could have been handled more economically with alternatives like tarps. The removal of walls and ceilings without clear rationale further fuels skepticism. Ultimately, he views the incoming leadership as a restoration of confidence in the Fed as a premier institution. Shifting focus to the housing sector, Poult discusses the robust growth in Fannie Mae and Freddie Mac's mortgage portfolios. Freddie Mac's holdings have reached $3.67 trillion with steady credit performance, while Fannie Mae's stand at over $4.1 trillion as of December. These figures reflect the GSE's role in stabilizing housing finance, especially after the 2008 crisis when they were placed under conservatorship. Regarding potential initial public offerings, IPOs, for these entities, Poultice stresses that all options remain viable under President Trump, who maintains flexibility in decision-making. The administration's approach has elevated these companies' visibility and utility, contrasting with prior efforts to privatize them at undervalued prices, such as suggestions to sell for $100 billion during Trump's first term. Instead, strategic initiatives like mortgage bond purchases have lowered rates, demonstrating effective leadership. Poultice credits Trump for enabling bold decisions that address the housing market's woes under the previous administration, which he describes as devastating. On the timeline for an IPO, Poultice suggests strong possibilities this year, but defers to Trump's discretion. The recent $200 billion mortgage bond buy, directed by the president, has already influenced spreads positively, potentially enhancing IPO prospects. This buy aims to inject liquidity, reducing borrowing costs, and making homes more affordable. Evaluating the bond buy's impact, Pulte notes immediate effects despite challenges from rising 10-year Treasury yields. Mortgage rates consist of two components: the base yield and spreads, the premium over Treasuries. While the GSEs can't control yields, tied to broader Fed policies, they have successfully narrowed spreads, leading to a 40% year-over-year jump in refinancings, with some regions seeing over 100% increases. This resurgence signals renewed vitality in housing, attributable to Trump's informed directives. Current metrics show the 10-year yield at 4.3% and 30-year fixed mortgage rates at 6.1% as of late January, slightly up from prior weeks. Poult attributes persistent elevation to Powell's policies, urging swift action from Warsh and Treasury nominee Scott Bessent, who have prior collaboration. With inflation under Trump at approximately 1%, rates should align accordingly, he argues. Wall Street anticipates 2 to 3 rate cuts in 2026 under Warsh, but Poult leaves specifics to the Fed, echoing Trump's call for materially lower rates given low inflation. He references tools like Truflation, which aggregates millions of real-time data points, showing inflation trending below 1%. Government data, hampered by lags in shelter costs and other issues, lags this reality. The current tight policy, tighter than during peak inflation, strains small businesses, Main Street, and lending. In response to queries on rapid cuts, such as 2 consecutive 50 basis point reductions, Pulte explains the benefits for housing. Lower rates act as vital nourishment for the sector, enabling affordable monthly payments. High rates under Powell have stifled activity across mortgages, credit cards, and more. With inflation at 1%, maintaining the Fed funds rate at 3.75% lacks justification. To expand on inflation's decline, consider its measurement and implications. The Consumer Price Index, CPI, a key gauge, incorporates baskets of goods and services, but alternatives like Truflation provide granular, timely insights by leveraging big data from sources like online prices, rental listings, and transaction records. This reveals inflation's slowdown to near zero in some metrics, contrasting with official figures that include backward-looking elements like owner's equivalent rent. Historically, inflation spikes, like the 9% peak in 2022, prompted aggressive Fed hikes, but the rapid descent under current policies validates calls for easing. Low inflation fosters economic growth by preserving purchasing power, encouraging investment, and stabilizing wages. In housing, it directly impacts affordability. A 1% rate drop can save borrowers thousands annually on a typical mortgage. Poult's optimism stems from coordinated efforts between the Fed, Treasury, and GSEs. Bessent, with his hedge fund background, complements Warsh's expertise, potentially harmonizing fiscal and monetary strategies. This could address the inverted yield curve, where short-term rates exceed long-term ones, signaling recession risks, though recent data shows resilience. Broader economic transformation, as Warsh noted, hinges on productivity gains from AI, automation, and biotech. The U.S. leads in these areas, with companies like those in Silicon Valley driving innovation. Fed policies must support this by ensuring capital flows efficiently, avoiding bubbles while promoting access. In housing, challenges persist. Inventory shortages, driven by underbuilding post-2008 and zoning restrictions, compound rate issues. The bond buy narrows spreads from 200-300 basis points over treasuries to more normalized levels, easing lender pressures and boosting originations. Critics argue such interventions distort markets, but proponents cite historical precedents like the Fed's mortgage-backed securities purchases during crises, which stabilized housing without long-term harm. Under Trump, this targeted approach aims at affordability without excessive risk. As we consider opposition from figures like Tillis, it's worth noting Senate dynamics. Confirmation requires a simple majority, but filibusters or holds can delay. Tillis's stance ties to protecting institutional probes, reflecting partisan divides. Yet, Warsh's credentials, Harvard Law, Morgan Stanley experience, bolster his case. The renovation probe exemplifies fiscal oversight debates. Comparable to other government projects like the Pentagon's audits, it questions efficiency in taxpayer-funded endeavors. If irregularities emerge, it could set precedents for accountability. Polt's role at FHFA involves regulating GSEs, ensuring sound operations. Under his watch, delinquency rates remain low, credit quality strong, reflecting prudent management amid volatility. Looking forward, potential IPOs could recapitalize GSEs, reducing government exposure while maintaining market stability. Valuations, now far exceeding prior estimates, underscore their value. Alternatives include recap and release models, blending public oversight with private efficiencies. The bond buys mechanics involve purchasing agency mortgage-backed securities, MBS, increasing demand and lowering yields. This pass-through effect reduces consumer rates, stimulating refinances and purchases. Data from Mortgage Bankers Association shows application surges post-announcement, signaling confidence. However, external factors like geopolitical tensions or commodity prices could influence yields. Oil fluctuations, for instance, affect inflation expectations, indirectly impacting rates. In summary, Warsh's nomination represents a pivot toward pragmatic, growth-oriented policy. Combined with GSE initiatives, it promises relief for housing and broader economy. As Polta concludes, gratitude for leadership enabling these shifts. We appreciate William Polt's insights today. Stay tuned to Worldview for ongoing coverage of these critical developments.